Okay, so we're talking about our second balance day adjustment this time. We're talking about accrued revenues. Now, the best way to talk about accrued revenues is probably to talk about term deposits. Now, for those of you who aren't sure what a term deposit is, you put an amount of money in a bank account and you're not allowed to touch it for a certain period of time, at which point they give you back the money plus some interest. Okay, so put it in the bank, lock it away, get it back later. So here I have a term deposit. It's a 12-month term deposit, and I put it in the bank on the 1st of March 2016. I put $50,000 in, and it pays 5% per annum. Now, if you do the maths behind that, 5,000 times 0.05, you get $2,500 in interest revenue. Interest revenue. Now, I've got my timeline down there, you can see. Now, this is where I put the term deposit in, on the 1st of the 3rd, 2016. And here is where I get the money out, on the 28th of the 2nd, 2017. And that's where they pay me $2,500 in interest revenue. Now, the issue that we face is that accrued revenue is revenue that we've earned but not yet received. Earned, not yet received. Important idea. So in this case, you can see that we have earned some interest revenue from the 1st of the 3rd to the 30th of the 6th, 2016, but we haven't received it yet. We're not going to receive it till this point. Now, from the 1st of the 3rd to the 30th of the 6th is 4 months. Now that means there's going to be 8 months worth of interest there. Now you can do a little bit of maths here, and I can walk around and show you guys how to do this. But 2,500, I'm going to divide that by 3 because that's a third of a year. That's $833.33. That's interest that I have earned but not yet received. And that's what this balance day adjustment's all about. So, the way that we run it, we need our journal entry here. The journal entry, the balance day adjustment, is happening on the 30th of the 6th, like it always does. And we're creating an asset. Remember I said earlier, pairs are assets. Accrued revenue is our second type of asset. So the asset that we're getting is revenue that has been earned but not yet received. Call that accrued revenue. Accrued interest revenue. Accrued interest revenue. The amount is this amount here, the stuff that we earned but not yet received. Now, what's the matching bit here? This gets a bit confusing because we did prepaid expense, which had a transaction that happened, but this transaction hasn't really happened yet, so we can't really match it with anything. But what's actually happening is we're getting interest revenue. So we actually match this against a revenue account called interest revenue. So all we're saying is we earned revenue at this point. We earned $833.33. Okay, that's our second type of balance day adjustment. You can see that it's fairly straightforward when you start thinking a little bit about these things. But that's 2 balance day adjustments so far: prepaid expenses and accrued revenues. We've still got 2 more to go.